Hi everyone, I'm Sabra and I will be your tutor for the module Investment Analysis. This is our first lesson and I am hoping to help you understand the content of this module during the next few weeks. If you have any issues, you could always, issues or queries, you could always email me. And as you know, this module is investment analysis. Now, before moving on with the content, I want all of you to pause this recording and take down a paper or a book and jot down in point form what you have learned or know about this session or the module. And after that, I also want you to jot down what you expect to learn from this module, and I hope that you would do this. Now you guys would wonder why I am telling you to jot down points when I'm supposed to teach you investment analysis. This is actually because I realize all of you are level 7 students, and I thought it would be useful for you all to understand methods where you can self-evaluate and check your level of learning yourself, because that is one of the most important things for a level 7 student. So at the end of this session, I will be asking you to summarize what you have learned and to do a self-evaluation. That is to see if you have gained more knowledge about the topic compared to what you knew before, and whether you have achieved the learning objectives or what you thought you expected to learn, and do a comparison. So this is not something that I came up with. So this is basically a learning method called the KWL table or chart. So if you want, you can Google about it. It's a learning method, and you can try to see whether this method will help you while you learn. So I just hope you understand what I mean there. So now let's move on with the content. Let's move on with the content of this module. So the module content. So as you can see, there would be four main module contents or themes. The first would be the capital structures, then the concept of investment, then the functions and purpose of the taxation. After that, it would be regulatory and audit process. So capital structures. So now, as you can see, initially we'll see in brief what we will be learning under capital structures. So capital structure is basically the way the organization is structured or financed. Generally, it would include a mix of equity instrument as well as debt instruments. And thereafter, we will be talking about these instruments and the characteristics, so forth. And thereafter, we will be talking about the concept on investment. So under this, what we would do is it generally considers things related to investment, where we will be talking about the money market evaluation investments and the yield basis securities, about risk, and also about portfolio management. Thereafter, we will be talking about functions and purpose of taxation. So under this, what is included would be the interest rate risk. Then we will also talk about hedging techniques, and then also talk about the subject area tax avoidance or tax evasion, just to know about the subject. So these are the main 4 themes that we will cover in this whole module. And the the content will be divided accordingly. So now moving on to the lesson. Now, if we talk about the lesson specification, now, as you can see, the lesson explains generally about the types of securities available. So we'll be talking about different types of securities, such as the equity instruments or like the debt instruments, what they are, the characteristics, and what are the differences maybe, things as such, so that you understand different types of securities. So as you can see, mainly the securities such as bonds, equities, derivatives, futures, options, and convertibles will be considered in this lesson. And also in this lesson, we will have a foundation knowledge on the securities, where we will be talking about different characteristics. And then we will also be including, we will measure the performance. We will use some sums, and then we'll talk about yields, do like a calculation on yields, and then also cover efficient market hypothesis. And then in addition, we'll help you to assess the risk of the securities in making investment and how that can be done. Okay, now moving on to the main topics. So as you can see, these are the subtopics that we will be covering under this particular lesson. But as you know, because we only have 4 themes, we won't be covering all these topics today. We will be covering a few. The first, I think we will be covering capital structures and bonds. That is what we will be covering today. And over the course of the module, in the lessons, we'll be covering the other sections as well. Okay, so initially, we will be talking about capital structures. So capital structures refer to the way an organization finances its assets through a combination of equity, debt, or hybrid instruments. There are deliberations by stakeholders over the mix of debt, equity to use. So capital structure, what is it? When it comes to capital structure, generally it refers to the way the organization is financed or structured, or the amount of debt and or equity that it uses to fund the operations or to buy the company's assets. So whenever a company requires finance, what it does is the company could either use equity finance or debt finance. And in some cases, they would also use hybrid instruments, which would be a mix of equity finance as well as the debt finance. So here, what does equity finance mean? So equity finance, equity represents the owners of the organization or the company, or to whom the company, the company belongs to these shareholders. We generally call shareholders. The company owners are generally shareholders. And now who are the debt holders? The debt generally represents the lenders of the company, or to whom the company is obliged to pay interest, as well as a capital repayment. And so basically, if you look at lenders, the organization or the company is obliged to repay them. There would be an interest rate, there will be an interest component that either they are supposed to pay annually or, at the end of a certain period that is mentioned according to the lending instructions. However, when it comes to equity, the company is not supposed to pay them back. I mean, there is no requirement to pay them back. And there is no annual payment that the company is obliged to pay. But obviously, when there is a dividend declared, then the dividend will be paid to the equity holders. However, but there could also be instances where the company is not making profits. If it's not making profits, it might have to pay to its lenders. However, it is not required to pay to the equity holders. And also there are instances, let's say that the company decides to keep that profit that they have to invest in some asset which generates more profits. So if that is if that is decided and the dividend is not declared, still that could move forward. There is no necessity to declare dividend just because the profits are there. So that's how equity is, and it's kind of when it comes to equity, it's a high risk asset because they are not repaid. As you can see. Okay, so as you can see, so whenever company requires finance, it will use equity or debt. And so equity, debt, and also I said that they could also use hybrid instrument, which has equity as well as debt. No, so now let's move on to another concept that we generally use when we do a calculation regarding capital structures. What is it? The cost of capital. So the cost of capital is the opportunity cost of an investment. In other words, the rate of return that a company would earn by investing in another project with the same level of risk as the investment that has been selected. So now just let me explain to you what cost of capital is. So we generally will be talking about, so when we talk about cost of capital, we will generally be talking about the company perspective, right? We're not talking about the investor's perspective. So for a business to run, what does it need? It needs funds or capital. So now, so from where does the company get the funds from? That's a question. So as we learned before, some company generally gets its fund using equity, the shareholder shares, as well as debt, the debt instruments. So now the next question we are going to ask is, what do these investors or lenders expect from investing in a company? Now, will they just invest without any expectations? I'm asking, will anyone just invest in a company without expecting anything? Will they? No, they won't. So what do they require? Have you thought about it? Well, they would require some sort of return. So if they require return, it would be a cost to the company, isn't it? So the investor invests on the company and they require some kind of return. So if they require return, that means the company needs to pay them. So it is, from a company perspective, it is a cost to the company. This is what we refer as cost of capital. That is just a simple explanation for you to understand. So without thinking too much, so That's why you call it the cost of capital, the cost that you incur from the capital. So as you can see, while I was explaining to you what was in this slide, I used the word the opportunity cost. So now I'm going to ask you, what is opportunity cost? So the opportunity cost, which is mentioned here, is a loss of the other alternative when one alternative is chosen. As in, if the investor invests in the company, then instead of choosing another option, it would be called the opportunity cost for the investor. So after that, we also talked about the rate of return. So I just thought that I should also explain, even though it's like a simple term, this is a term that we will be talking about throughout this whole module. So I thought it's very important for a person to know what the rate of return is, as this is the introductory session. So what is the rate of return? What do you mean by rate of return? So rate of return is the annual income from an investment expressed as a proportion. Usually it is a percentage of the original investment. So when you moving on in this module, the word rate of return will be used many times. You guys will have to do a lot of sums where a rate of return is mentioned as a percentage. So it will be very important that you know what you are calculating, not just, mathematically calculating and getting the correct answer. I believe you need to understand what you are calculating and why you're calculating. So I thought it's very important to just simply explain what rate of return is. So now, depending on the source of finance, the cost of capital could vary. So why do you think the cost of capital differs? Have you thought about it? The cost of capital will depend on the investor's expectation of return. So equity holders generally have a higher risk because the shareholders only receive whatever they are supposed to receive, receive the residual value after debt investments are repaid, and will only receive an annual payment based on the dividend declared. So generally, when it comes to debt, there is a legal obligation to pay a specific amount. But when it comes to equity holders, if there is no profit, there is no need to pay, even unless the dividend is declared, there is no necessity to pay as well. Even though obviously the company needs to explain to the shareholders why they are not declaring the dividend. So whereas the company has a legal obligation to repay the debt, and there will be a fixed payment schedule, including the annual mandatory interest payment for the debts. Therefore, the debt have a lower risk compared to the equity, because their expectation would be less, because they know obviously they are going to get paid annually, and there is no risk as such. So, as we said, depending on the source of finance, the cost of capital could vary. So it depends whether it's an equity or whether it's a debt. So it could be computed for different financial sources. The cost of capital will depend on the investor's expectation of the return. So the expectation, obviously, of equity holder will be higher than the expectation of the debt holder. So for higher risky asset classes such as equity, the return expectation would obviously be higher if if the expectation is high, that means what? How did I explain to you the cost of capital? I told it depends on the expectation, right? So if the expectation is high, that means the cost of capital is high. So if it's equity, it's a higher risky asset. The expectation is high. When the risk is high, the expectation is high. Therefore, the cost of capital will be high. So right after, we will be talking about financial instruments, or the IAS 32. So now let's moving on to IAS 32, which includes the legal framework that a company needs to follow. IAS 32 talks about the financial instrument and the legal side of it. So generally, IAS 32 requires the issuer of a financial instrument to classify its initial issue as either a liability or an equity. So as you can see, the IAS 32 requires to classify its initial issue cost as a liability or equity. And as you can see, according to the following classification principles. So when you're classifying as a liability or an equity, then the organization needs to, consider the classification principles that are included under the IAS 32. Now let's see what it says. So the substance of a financial instrument rather than the legal form governs its classification. So first, when you're classifying, you need to consider the substance, not the legal form. And then when there is a contractual obligation, potentially unfavorable to the issue of the instrument to deliver either cash or another financial asset to the holder of the instrument meets the definition of the financial viability. So as you can see, when there is a contractual obligation, which could potentially be unfavorable, which needs to deliver some kind of cash or some kind of financial asset to the holder of the instrument, that means the company needs to include it as a financial liability. So when an instrument does not give rise to a contractual obligation under potential unfavorable conditions, then the instrument is then classified as equity. So if whatever the financial instrument doesn't have any type of contractual obligation, which has an unfavorable condition, then the instrument would be generally classified by equity. So when there is a requirement for mandatory redemption of the instrument by the issuer at a fixed or determinable future date, the instrument meets the definition of a financial liability. So now when we go through all that, what we understand is when it comes to financial liability, it would, if we are supposed to include it as a liability, that means there will obviously be a contractual obligation to repay. And with that, there will also be a mandatory redemption. So the mandatory redemption describes the repayment of fixed income treasury, such as treasury notes, certificate of deposits, or even bonds on or before its maturity. That's what it meant by mandatory redemption. So if the whatever financial instrument has a contractual obligation which is potentially unfavorable, then the company needs to obviously include it as a liability, which is fair. Now, when it comes to equity, if there is no contractual obligation and there is no unfavorable conditions, then what? Then obviously the company needs to include that particular financial instrument under what? Equity instrument. Now let's move on to the capital structures. And we are talking about the sources of finance. Now moving on with the sources of finance, as you can see in this slide, sources of finance, there are three types of sources of finance. One is based on its term. So as you can see, there are instruments which are short term, instruments which are medium term, instruments which are long term. So how do we segregate short term, medium term, and long term? So generally, when the instrument is for a time period which is less than 12 months, then it is considered as short term. When the period is, let's say, more than 1, less than 5, within 2 to 4, generally it is considered as medium term. And if it's more than 5 years, obviously it is considered as long term. And now we will talk about 3 classifications that we have based on the type of instrument. So we actually talked about this. This is based on the type. The sources of finance could be equity instruments, then it could be debt instruments, thereafter it could be the hybrid instruments. So when it comes to equity instrument, it doesn't necessarily mean it's just the share capital. It would include the share capital as well as reserve. So when it comes to reserve, this is a particular amount that the company generally keeps as reserve to be used for certain important decisions instead of paying everything back to as dividend. So equity would include share capital and reserves. And when it comes to debt instruments, what are they? Those are the ones for which the company is supposed to pay 2 things. One thing, there would be a mandatory requirement, obligation to pay the capital amount, as well as an interest payment. It could be an interest payment. You could call it a coupon payment, it depends. So anyway, there'll be 2 sections under debt instruments. One would be repayment of the capital. The other would be it would basically be the annual interest payment. We can, it depends. Sometimes it might not be annual. It depends on what is included in that instrument. But there would be an interest in payment which the company needs to pay other than the capital repayment. Then there would be hybrid instruments, which will obviously be a mix of equity as well as debt instruments. So I just hope that you understand that the source of finance could, can be categorized based on term, as you can see, short term, medium term, long term. Thereafter, based on the type, equity, debt, hybrid, which we have been talking many times today. Okay, now moving on. This shows the topics that we are supposed to complete. So we completed the section capital structures, and now we will have to move towards bonds. Now let's see what a bond is. Okay, so a bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or a government. So what does that mean? So a bond, if I simply tell you what it means, you can consider a bond as a IOU. Bond could be thought as an IOU between a lender and a borrower that includes the details of the loan and the repayment payment. So that is what bond means. And so bonds are generally used by companies, not only companies, it can be used by governments, municipalities, the states to finance its projects operations. And the owners of bonds are called bondholders, while the creditors are creditors of the issuer. So now generally we think that any financial instruments are needed only for companies, but when it comes to bonds, we need to understand even the governments generally do have bonds that are used to finance its projects and operations. Sometimes it could be highway projects, it could be solar electricity generation projects, those kind of projects. Okay, now bond details include the end date when the principals of the loan is due to be paid to the bond owner, and usually include the terms for variable or fixed interest payment by the borrower. So generally, what does bond include? The bond generally includes the end date, and then the bond owner will have to kind of pay a set of interest payment. It could be a fixed percentage or it could be a variable rate. So it depends on how the bond was, the instruction of the bond is. And lastly, it says that the bonds are secured. Now, the payments, bonds are secured. What do you mean by bonds are secured? It means that bonds give a security in order for repayment. Generally, bonds, the banks are the ones which give a security in order to for repayment. Now, let me just give you a simple example for you to understand what type of security a bank would give and why we say a bond is secured. So I'm just going to take like an example which all of us know about. This is about getting a housing loan. So generally when you take a housing loan, what happens is the bank takes the house as collateral, right? And then for the repayment of the loan, it is kind of kept as collateral. And if you're unable to repay, what happens? So the bank would tell you to repay, but if you're unable to repay, what the bank does is it will auction that particular house and then cover its investment. So this is why bonds are called secured, because you know the ones who buy bonds would know that they would anyway get their repayment. So now generally when we talk about bonds, payments in bonds are generally yearly. However, one could include it as also a lump sum payment. When the term is complete, it can be requested actually. So generally it would be yearly, but there could be a request where the payment is done like at the end of the bond period. It could be even once in, once in 2 years or so, I don't know. It depends. So that is about bonds. And now we are going to talk about the recognition of a bond in the different stages of its life. Now, how do we recognize a bond? Okay, this is actually something that we learn under financial accounting, isn't it? But however, you just need to, because we're talking about bonds, we just need to know what a bond is, how it is recognized, and this will obviously be used in financial accounting because it's just generally how it is recognized and how the accounting is being done. Okay, so now about the stages, we'll be talking about two stages. One would be the initial recognition. That would be the first stage. Then thereafter, I will be talking to you about the subsequent measurement. So initial recognition. So bonds are generally initially recognized as at the amortized cost. Now, what is amortized cost, or what is amortization? Do you know what it is? So let me just kind of explain. So amortization is generally the action, or the process of how you would gradually write off the initial cost of any type of asset. So as an example, I can just, one of the examples that I could say about writing off an asset would be non-current asset. In accounting, we use this, don't we? We just take the written down value, and we, over the period of time, we keep on writing down, the value. So this is something like that. So this amortized cost will be initially recognized. So initially, it would be recognized at the amortized cost. Of initial cost will be amortized. However, the treatment of issuance cost differs for IFRS and US GAAP. So now, what is issuance? Issuance is generally the cost that you incur while trying to get the bond prepared, right? To supply and distribute, all the extra expense that you put into issuing this particular bond is the treatment of it would differ according to IFRS as well as US GAAP. So now I will be talking to you how it differs. So first, I will be talking to you about the IFRS and how IFRS would treat the issuance cost. So when it comes to the issuance cost, the bond issue costs are added to the value of the bond and generally recognized in the balance sheet as a liability. So what happens is there is a face value of a bond, right? So what they do is you take the value of the bond, and then the bond issue cost is added to this particular bond, and then you include it under liabilities. So that's how the issuance cost is treated under IFRS. Now in US GAAP, it is a little different. So what happens is US GAAP requires that the issuance cost to be recognized as an asset and be amortized over the life of the bond. So when it comes to the issuance cost, what US GAAP says is that this cost is actually an asset, because you incur this cost in order to get this bond. Therefore, this is being amortized over the life of the bond. So that is what I was actually talking about in amortization before, just to explain to you. Initial recognition bonds are just amortized as in written off, but in the issuance cost generally will be amortized over the life of the bond. So as you know, I told an example, right? How we use the non-current assets and then we write it down. That example is actually for this, the US cost, US GAAP issuance cost. That is what we need to use that example for this section. Okay, and now when it comes to bonds, Now, bonds can be issued at a premium, that is a value which is above their face value, or it could be at a discount, which is a value which is less than their face value. Okay, so now let's see. So this premium and discount is generally used during the subsequent measurement or the next measurement, after you amortize the issuance cost and the bond value, this extra premium or the discount need to be measured. So now let's see how we measure if a bond is issued at a premium. Okay, so if you're talking about premium, what does premium mean? So premium is where the carrying value of the bond is more than the face value. So as an example, if I say the face value of this bond is 100, then the carrying value obviously would be 120, right? So the carrying value would be more than the face value. Therefore, it is issued at a premium. So this particular premium will be amortized over the life of the bond. So what happens is you take this particular premium and then it is amortized over the life of the bond. So this is what premium means. Now, if the bond is issued at a discount, a discount is when the carrying value of the bond is less than the face value. So now I told that the face value in the example before, I told the face value is 100. So if the face value, I will use the same example where the face value is 100. So if that is so, what would the carrying value of the bond be? So if it's a premium, the bond value, I said 120, it was any amount more than that. So here the bond value would be less than 100. So it could be 80, it could be 90, and it would be an amount less. So that particular, the difference is the discount. So that is a bond which is issued at a discount. So now in case of a discount, in case the discount will be amortized over the life of the bond, the carrying value will be written up to the face value over the life of the bond. Now here, so because it's, even though it is the carrying value is less, okay, we won't be just amortized only the carrying value. We will be amortizing the face value. So that means the discount also needs to be written up. So that's how we do the measurement. This is how we recognize the bond in the different stages of its life. So we spoke about the initial recognition. Thereafter, I spoke to you about the subsequent measurement. And during subsequent measurement, we just talked about the premium and the discount. So now let's talk about the bond recognition in the balance sheet. Now, how do we recognize this in a balance sheet? Now, this involves two steps. So the initial step is how, so generally the balance sheet is reduced by the carrying value of the bond purchased. So effectively what happens is we remove this particular balance, the carrying value of the bond from the balance sheet. And then if there is a gain or a loss on the purchase of the bond is recognized in the income statement. So if there is a gain, what happens is obviously you will be adding it in as an income in the income statement. And if there is a loss, what happens is we would be including it as recognizing it as a loss or an expenses in the income statement. That is how we include This include the bond amounts in the balance sheet as well as the income statement. Now, let's move on to another section, which is debt finance. Now, we just spoke a little about debt and equity, but this basically talks to you about the debt finance section. So as you can see, debt finance is provided to a company by its lenders. The feature that differentiates the debt from equity is the risk of the investor. So actually, we spoke about this, right? When we were talking about equity, where we explained that the expectation in equity is high. And here now what we are saying is the expectation of a lender would be low compared to equity because the risk is low. So because the risk is low, obviously, now I need to remind you, if the risk is low, the cost of capital, what will happen to the cost of capital? The cost of capital, yes, it would be low. So as you can see, the feature that differentiates debt from equity is would be the risk factor. So debt has a lower risk as a company is obliged to settle the investors, unlike the equity. So yes, now when it comes to debt, does it have any, compared to equity, their risk is less. Why? As I mentioned to you, the company is obliged to settle particular amount. Every year there is a mandatory payment. If there is an annual payment that is required or mentioned, that means the company needs to pay it. That is legally obliged. The company is legally obliged. Because of that, unlike equity, their risk will be lower. And so let us talk about some typical sources of financing methods. So one is the bank, then the credit unions, savings and loans, the amounts that you get from finance companies. These are all debt finance. Okay, moving on. Now, when we're talking about debt finance, we are now also talking about a particular debt finance that we generally talk about, which is debentures. This is something that generally, companies talk about, and it's something that generally investment, when you talk about investment analysis, is something that comes up a lot. So now let's see what a debenture is. So a debenture is a financial instrument which entitles an owner a coupon payment and a possibility of a capital redemption. So basically, debenture is a financial instrument, and the owner is entitled for what? It's a coupon payment. So what is a coupon payment? Now you wonder what coupon payment is. Coupon payment is actually something like the interest payment, okay, and the possibility, and so that means in this financial instrument, we are supposed to talk about the coupon payment, and then we are also supposed to talk about the capital redemption. That is, redemption as in the payment that the capital is supposed to be paid back to the lender. So a debenture also would have two things. One, it is not the interest payment, it is something called coupon, and then there's the capital redemption, and you just could call it loan stock and bonds and other names. And so now let's look at the coupon. So the coupon is generally calculated on the par value. As you can see, the coupon is calculated on the par value of the debenture, not its market value. And the book value of the debenture would also be the par value. So you need to understand, even though the debenture market value could be higher, it would not be used to calculate the coupon rate. So basic par value will be considered. And even when including in accounts, the book value for debenture would be the par value, not the market value. And now when it comes to debentures, there are two main types of debentures that you talk about. One is redeemable debenture and the other is called irredeemable debentures. Now, redeemable debentures, you know what that redeemable debenture is? Redeemable debenture is where the debenture capital is repaid. And irredeemable debenture is where the debenture capital is not repaid. So if it's a redeemable debenture, the company will buy the debenture from the investor. So because it's a redeemable debenture, the company will be buying the debenture back because they'll be paying the capital back, right? But when it comes to irredeemable debentures, what did I say? That the capital is not repaid. So then what does the investor do? Now, if the investor doesn't want this debenture, how does he get the capital back? Can he just keep it? No, actually there is a way that they can, redeem it. That is, they will have to find a buyer to sell this particular debenture. So if he needs to exit from it. So as you can see, redeemable debentures and irredeemable debentures. Now I talked about the cost of capital, right? Now I said debt finance, the capital cost of capital is less. But still, if let's say we compare redeemable and irredeemable debentures, now based on what I said, what do you think? Which would have a higher cost of capital? Would both have the same cost of capital? No. Which one would have the higher cost of capital? The higher cost of capital would be for the irredeemable debt. Why? Redeemable debt has less cost of capital, as there's less risk because the company is going to pay you back. So as I told you, if you understand the main concept, which is, if you understand what cost of capital is, even when you're talking about different types of the instrument, if you're just told about an instrument, you will be able to compare and think and then figure out which one has a higher value, right? Okay, I just hope that kind of helped you and helped you think a little extra. So as you can see, if it is a redeemable debenture, the company will buy the debenture from the investor at an agreed price. However, if it's not redeemable, then what happens is there will be no such agreement. Therefore, the investor needs to find a buyer if he wants to exit. However, a company should have a required scale of credit worthiness to issue a debenture to be attractive. So now generally debentures have a higher value than a normal loan interest rate, bank rate. It is because there is a higher scale of credit worthiness. So the company should show that there is a higher scale of credit worthiness for an investor to come in and then, invest in this debenture. So debentures could be secured debentures as well as unsecured debentures. So one way was redeemable, irredeemable. Then the other categorization of debenture, as you can see, is secured debentures and unsecured debentures. So secured debentures will be paid before the unsecured debenture holders. Now I am going to ask you a question like before. Now secured debentures and unsecured debentures. Now tell me, just think about it. Which debenture would have a higher cost of capital? What do you think? Would it be the secured debenture or the unsecured debenture? So secured debenture holders should be paid before the unsecured debentures. So what can you remember from what I taught you? What did I say when it comes to debt and equity? So I talked about the equity and debt comparison. So I said debt is repaid before equity. That is one of the reasons why the equity cost of capital is higher than the debt. So now when it comes to secured debentures and unsecured debentures, which one will have a higher risk and a higher cost of capital? Something that you can think about. Okay, so unsecured debenture would obviously have a higher risk, right? Because secured debentures are paid before them. So that means, will it have a higher cost of capital or lower cost of capital? Unsecured debenture holders and secured debentures would obviously have a higher cost of capital. Just hope you understand what I'm talking about. So now, as you can see, the next part of this particular lesson would be the types of debts or bond financing. There are 7 types, which includes debentures. Actually, we spoke a lot about debentures now. And then there are zero coupon bonds, the bank loans, deep discounted bonds, Eurobond, convertible bonds, and convertible warrants. But we will not be talking about it today. We will be talking about it in our next lesson. Okay, now I am going to ask you something. So now, do you remember at the beginning of this session, I told you to jot down what you want, what you know about this particular module and what you think you will learn from this lesson, and what you now I want you to jot down or summarize what you have learned throughout this particular lesson. So this is for your learning, and so now you can go back and compare what you learned and check whether your expectations are met. Like, this is a self-evaluation, guys. I'm not going to ask you what you wrote or I'll tell you to share it with me, but I think it's a good method to follow for a level 7 student, as you can check what you know before and what knowledge you want obtained after the session. And you can you can even think, did I learn something by going to this lesson, or was it the same thing that I learned? Okay, you can just analyze and see. And then where you you can also think, were you able to bridge the knowledge gap if there was a knowledge gap? And which areas can you improve on, right? You can think about all that. And generally, this particular analysis will help you or encourage you to improve where you can, and it will show you where you need to improve, and it helps you to prepare, to evaluate, to learn, to motivate yourself to learn more. So now, let's do a recap of what we learned today. I'm just gonna go and do the recap, and let's see. Oops. We will be doing the recap. As you can see, right, I think I just went all over. Yeah, so I will just do the recap based on the modular topics, right? As you can see, we spoke about capital structures and then we spoke about bonds. Under that, there were several topics that we spoke about. Because the time is up, I would like to end this session. And I just hope you had got a good understanding about investment analysis. And I hope that we would continue with the next sections in our the coming weeks, and hope to see you with the next lesson. Thank you very much. I hope you have a nice day. See you.